Hello and welcome to the Property Trio. It gives me great pleasure to be playing host again this week. And we've got a great listener question that we planned to answer in a past ep, but today is the day. Kim asks us a great question about life after property acquisition. She says, I'd love to hear more about what to do with property portfolios for those nearing retirement. Do we transfer it to our kids, sell some off, or live on the rent and sell off when we're really old? How do investors determine when they've acquired enough property to cease the acquisition phase? Dave, I want you to answer this one.
Well, there's a one sentence answer and then there's a lot of sort of depth underneath that. But the one sentence answer is, does it align with your retirement goals? So, does your financial position from property align with what you want in retirement? Now, that obviously is the one sentence answer. If you break that down a little bit further, well, what's your income goals? Now, there's obviously your rent from property, there's your superannuation and what you expect to get as an annuity from your super, and then any other investments you may have. Now, obviously, you also might have goals for your net asset position, realising that the reality is as we transition into retirement, generally speaking, the return, the rent, the percentage return, which is called the yield of the value of the asset on residential property, is often lower than you can receive through other investments. So a decision to be made maybe to sell one or multiple of your residential properties and actually put that cash into some other form of annuity that's going to provide you with a greater level of income than you receive from rent, and also less headaches and overheads that can come with owning residential property. Another piece of the puzzle is how much debt you have. And often that's an emotional decision in terms of, I just don't want debt as I enter retirement, so I would like my debt paid off. A lot of retirees from our experience, our business is 20 years old, have been in the Cate for 25 years now, so we've had quite a few people go through that journey of accumulation and then retirement, and often they just don't want debt as they're going into retirement. So, these are personal. It really comes back to your goals, what you're comfortable with, your risk profile. I mean, it's the same stuff that I talk about from time to time, but that doesn't make it easy just because you can say what they are in a sentence or two. There's a lot of talking, discussing between yourself and your spouse, number crunching with whoever your advisors happen to be, whether they're financial planners, tax accountants, property planners, strategic mortgage broker, to get to what is the right answer for you. And, the right answer for you will not be exactly the same answer for your spouse from my experience as well. So, you still need to find that balance within that. And, dealing with retirees post, I guess, retiring who've been clients of ours, this actually often also boils down to family home discussions as well, and different sort of emotional connections to downsizing versus not downsizing, how we downsize or right size, and also how physically capable we are as we go through those progressions, hopefully, of later life. So look, there's the simple one sentence answer, and then there's a lot to work through underneath that.
No, that's great. And it's a very hard question to ask you to answer in a couple of minutes. But what it details is there's so much to, planning your retirement. Now, there are various options for investors holding property once they reach retirement. How do you make that decision to trigger a different lifestyle that's derived from your earnings on your investments? Mike, can you give us a run through of just some of the popular various options and ways that people go into retirement when they've got investments?
Yeah, there's a lot of different pathways, and I guess it comes down to Do you want to reduce your debt? Do you want to maintain your debt? Do you want to have no debt, as Dave said? And sometimes that's an emotional decision rather than necessarily being the best financial decision. I mean, debt can be quite a helpful thing. In fact, it's quite necessary if you're wanting to generate sizable wealth with property, but there might come a time where you're just like, oh, I don't want that hanging over my head. So you can definitely sell the properties and downturn your debt or decrease your debt or eliminate your debt. But of course, you'll then get exposure to taxation. So say, for example, we go down the path of just retiring the debt with the rental income. So obviously you get into that cash flow position, you can chip away down at the debt, and you could feasibly get to a point where there's zero debt and then you're not having to pay capital gains tax because you haven't sold anything. Let's say you have 10 properties and you've got an LVR of 50% across the three. You might be able to sell 3 or 4 of them, or depending on the value, and have zero debt and then just live on that income. Of course, you'll pay capital gains tax on the investment properties. You could sell the whole thing, just flog it all off and chuck it into Bitcoin, or this is not financial advice, please see your financial planner. But
maybe say another example of an investment.
You could put it into equities or a managed fund, or you could invest in grain futures. The world's really your oyster. The benefit of that is there's just a little bit more liquidity to that, and you've also got much more of a capacity to diversify into all sorts of different assets. You could sell your home, which will be CGT free, and move into one of your properties, which may or may not be suitable. And that was actually a little note from yourself, Cate. And I looked at that and I went, oh, that's a good one. I hadn't really thought about that one. So I'll give you credit for that. You can also just, as I say, not necessarily worry about the debt, and continue in the cash flow positive position that your portfolio might be if you've been accumulating for a period of time. Kim did sort of mention you can give it to your kids. I guess that depends on how much you like your kids. You could also donate it to your favorite charity or something like that. And I know, Cate, you've got some good stories around how that can be done as well.
It's quite a special auction when you're dealing with something that's being donated. And I've had a couple now. It can bring tears to your eyes when it's a very heartfelt donation or when it's a big quest. But what a great thing to do. And it's something that I think we'll see a little bit more of. We do have some, really philanthropic people out there and some great causes. And we have a lot of wealth tied up in residential property in Australia. So not something to overlook, because if you've got a great portfolio and you've built an amazing estate and your plan is to gift it all to your kids when you leave this earth, you do have to ask yourself how much is enough for them, and how much are you taking away their dreams if you're just gifting them stuff. None of us want Nepo kids, but donation is definitely something that I would encourage wealthy individuals to think about.
Probably depends how many kids you have too, and how old you live too.
Yeah, that's right. I mean, if you've got a great long life and your children are already established, a lot of high net wealth individuals or successful property investors understand the game quite well, and they know how to help their children get into property so that it's actually their achievement. And all things going well, by the time you leave this earth, your kids have grown up and they've got kids. Do they really need your fortune? So they're all questions that people ask themselves when they're estate planning, and they're very valid questions. So many people come to me saying that they want to help their kids or give them a property one day, but not many people come to me saying, my kids don't need more. I've already helped them. What else could I do? And I think that's a really special question to ask, a financial planner or a strategist or anyone who's helping you with your estate planning.
Well, Kim, I'll be riding in Thailand for orphanages in Thailand that sprung up out of the Boxing Day tsunami. So happy to take donations there. A house is probably a bit much, but Jimmy,
You'd
a
win.
couple of bucks. But yeah,
Definitely smash it, wouldn't you?
there's a million different options in the end, and I guess that not to sort of do similar to the beginning. It does require a little bit of planning, like how long do I think I'm going to live, and I think it's always a good idea to give yourself a little bit of float, and what do I actually want to do with my retirement? Do I want to travel the world? You know, do I want to pick up ridiculously expensive hobbies? I mean, you sort of need to do that work and then kind of backfill the strategy as well.
Yeah,
Well, and
absolutely.
even just in today's financial review, I think on the insert of the front page, there's a lengthy article on how most people need a lot less superannuation than they think they need. And so that's a good news story. And yeah, that therefore we probably spend less in retirement than we actually are able to, because we're more worried than we need to be about um, how long our superannuation is going to last us and how it's going to go funding our retirement.
Yes. Dave, I want to chat with you about the pros and cons of holding everything versus selling some to retire the debt.
Yeah, look, I guess the main pro of holding everything is you continue to grow your asset base and your income position, and maximize that for as long as possible. So obviously the reason you buy assets to begin with is because hopefully they outperform inflation and the rise in the cost of living. So therefore it just makes hopefully it's intuitive to our listeners that the longer you're able to hold those assets, the likelihood is you're going to be in a better financial position. So therefore, there's a real benefit to trying to hold for as long as you can, and that is something to be mindful of. That just because you've hit retirement, it doesn't mean you need to sell. And if you actually can find a way to manufacture pulling things together so that your income cash flow from whatever your investments happen to be, obviously including superannuation, it enables you to maintain your lifestyle, then I'd encourage you to try and hold for as long as you can, particularly if you have multiple assets, because you can always sell one when you feel like, okay, it's time, we need to do it now because the money's run out.
That's a really good point, Dave. I like that, because I think there's this mindset of, okay, well, I'm retired, so I need to retire all the debt and sell all the stuff and get this huge big sum of cash and then just kind of whittle it down. But if you retire at 65 and you live into your 80s, like think about 20 years of capital
Yeah.
growth on one property, let alone if you own a number of them. So yeah, I mean, my personal view would be like, don't miss out on the ride that you could be getting. You could get another 2 cycles on your whole portfolio if you're able to hold on to them. And I don't think enough people think about the value of that.
Absolutely. And the only part to that I'd challenge is the maintenance. That's the one thing. I've got a husband who's 10 years older than me. I've said that before, and he's technically retired, but does my bookkeeping. And our plan was always to hold the properties as long as we could to enjoy that continued capital growth. But the thing that can get you rethinking that is when you've got maintenance to deal with, particularly if it's not close by. But all in all, I think having a manageable asset base that is close enough by, or you do have reliable property managers and you have coordinated trades and you can hold it, of course, that will see you get the best result long term.
Yeah.
And a good PM should be able to take that pain away. And, the tradies, they like looking after property managers because, they might have thousands of managements within that office and they're the go-to plumber. So, they tend to get a better service than just, say, you and I jumping on the yellow pages or whatever people do these days. I don't
You'd
think
like
anyone
to
uses
think
yellow
so.
pages.
Yeah, it can
Yeah.
be a bugbear of mine. You do tend to find that in some areas, particularly when there's an interstate investor, I know some trades will take advantage. They'll, puff up the quote or
Right.
give you more stuff than you actually need, and particularly if you're in an area that isn't close to a capital city, so you've got less trades and they're travelling further. You've got to factor in those costs. But all in all, when you've got a great property manager who's on it, I agree with you, Mike. Their tradies don't want to let them down.
Yeah. And look, I think if you have multiple properties and you feel like you're in the position that, your comfort levels means that you would like to sell something to reduce debt and feel a bit more comfortable, then take a methodical approach and look at, okay, well, if you do have multiple investment properties in particular, which asset is the best one to sell to put me into the position that I'm comfortable with, and how do I, try to make as few sales as possible, basically, if you own multiple, and which one is the most appropriate one. And if it can be the one that's providing you with the least amount of income and has the least amount of equity, well, that's ideal, because obviously you're keeping more skin in the game, and we've just talked about the benefits of that. And it's not just your net asset position that's improving, your rental income will continue to grow as well over time.
Yes, so true.
The good thing too is if you're flogging one off, right? Let's say you have 5 or 10 of them. You can pick which one you like, right? You could be it's that bloody one with no trades in that regional location. I'm sick of that.
Yeah.
Or it's the one that, I really thought that was going to be a capital growth monster, but it's done nothing. Or, I'm just...
The one, the kitchen's really tired and I really don't like that floor plan. I just
you
can't
guys
be
could have
bothered.
10 beers with Ian and talk about the properties that you want to offload. Feel like I'm drinking wine on a Saturday night. When is property investing not a good idea? This is a rhetorical question here. It's not a good idea when you're wanting to retire and you're scaling yourself up and looking at negative cash flow, because that gets you on that treadmill where you have to stay at work or think about letting go of other properties and jumping in and out of property, trading property in a short period of time. It's a big fat no-no for me. So that's what I would avoid when I'm getting closer to retirement. But Mike, I want you to answer, why is diversification so important?
It's hard to answer this without sort of saying the same thing everyone always talks about with diversification. And it always involves, poultry, produce and baskets, so I'm going to try not to talk about that. But of course, the greater the exposure that you have, and let's take property for an example, the more you're mitigating the risks of downturns of one particular one. So if we have one property, let's say a blue chip property in one particular city versus 3 properties that maybe are regional, but it all kind of equates to the same price. Of course, you got multiple property managers, you got multiple stamp duties, so that all kind of factors in. But if something happens and you've got that one property and that location is not performing, well, that's really all you've got. Whereas you could have one property that's not performing and then one market that's flat and another one that's growing, and it kind of evens it all out. And if you think about, if anyone looks at their sort of super portfolio or they invest in a managed funds, you get to see that little pie graph, right? And you never really see one particular asset more than about 30 or 40%. There's quite a spread, and it might be international shares, it might be domestic equities, it might be a mixture of cash or all sorts of things. But that sort of gives you a bit of a clue about how the pros do it, right? The managers of funds in superannuation funds and managed funds don't like a huge exposure to one particular asset because of the risks of a downturn in that particular one. And it's just a lot easier to sleep at night knowing that there can't be just a single event that kind of ruins your future.
Nicely answered. Now,
and
Dave,
I didn't say eggs in one basket until now, so
I
want an extra point for that, Dave.
Clarify for our listeners before too that the PM stands for property manager.
I know all these acronyms, and we forget about how many there are, don't we?
We can
throw them around. We always need to bring ourselves back and remember that our listeners are potentially, in other industries and other segments of the world, and not necessarily across all of this. So,
good point.
Apologies for that. Dave, what other lifestyle conversations should people be having with their advisor when they're planning retirement?
Well, I think when it comes to lifestyle, you need to be talking about travel. You need to be talking about really stripping back and looking what your living expenses are and making sure you do that correctly. If you're going into retirement with some debt, but you plan to pay that off, you need to strip that out. And yeah, so it's worth doing a deep dive on your expenses of the previous 12 months, what stays, what goes, and then, what you'd like your lifestyle to look like. And, travel's the most obvious one, but then they're still looking at things like hobbies, how often you're going to upgrade your car,
Yeah.
and other factors such. Are you going to, is there things you might do to support potentially grandchildren with schooling costs, which is a pretty common one nowadays, particularly with private schooling. And, the percentage of Australians who attend private school has increased over, and seems to continue to be increasing. So that's a common one as well.
I think about your own personal health,
Yeah.
and elderly parents, family opportunity, like you said, grandkids. Do you want to help them out? Are your children reliant on you for anything? Have you got anyone close to you that has special needs? All of those human things that are so important. And I think provisioning for your health cover is absolutely critical. So
I think another one too, and this can change, evolves as you get older and less physically capable. But what are the things with your home that you can do to make it more, less maintenance involved for you? What are the things you can do to your home if you're going to keep it and you see you'll live in that for another 5 to 10 years, the current one, to make that home more pleasurable for you to live in? And, often, we can put things off while we're working and, while we're going through the accumulation stage of life. But I think retirement's a time to really, give yourself that gift, I suppose, of making the place you live really tick all the boxes from a pleasure perspective, but also from, minimising maintenance and things like that.
Well, on that note, we've come to an end with this episode, but before I let you go, we do have time for some gold nuggets. So if you want to put on your thinking cap, I'm going to throw my gold nugget out first.
Now it's time for us to go mining for our gold nugget property tip of the day.
We chatted before about the downside to gifting your kids property or leaving everything to your kids. There's certainly upside, but there's also a potential downside. And I think there's a conversation there about helping grandchildren. And I'm in a wonderful position where I get to meet all kinds of people that are purchasing property, and some of the most joyous assignments are when I'm talking to young first home buyers who have had a gift from a grandparent. And, it's a real joy. They don't necessarily inherit a whole property. Sometimes they do, though, and they're able to continue investing or purchase a family home with that money. But I think there's a lot of scope there to make a real difference for grandkids and to talk to a qualified person about your estate planning so that money is there in trust and it does something spectacular for someone that you love.
Yeah, look, my gold nugget would be essentially sit down with an expert and properly model out your plans. So I think you definitely need to sit with a financial planner and work through your planning through to retirement, beyond retirement, estate planning, and then if you want to specifically focus in and narrow in on property and, obtain independent property advice, because I think the reality is that some financial planners will be more skewed away from property because that's how they earn their income, then do the same via a property plan. But I think you have to get at least the financial planning advice to do it properly. And, you need someone with the expertise in this area and someone who has the software and the skills to model out the actual numbers for you. There's so much nuance that you need to understand about transition to retirement that you really should invest in personalised advice.
100%. I think the tax implications alone would make most people's heads spin. And I couldn't agree more, Dave. That's the critical part. You need to make sure that all of that hard work that you've done over the decades is not falling prey to making a poor decision where the tax implications punish you.
Yeah.
I don't know Kim's exact position, but I like efficiency and I like maximising upside and potential. So she might be in a position where she's actually got a sizable stack and might decide, look, okay, I'll just flog everything off and park it somewhere. But the difference between doing that and considering some of the things that we talked about, like setting an actual plan and figuring out your health and your travel, and do you want to have a live-in care, or are you, coveting a particular place where you want to live out your final days? We're talking, potentially hundreds of thousands of dollars of different depending on the strategy and those decisions. Everything's kind of multiplied at the back end compared to what it is at the front end. I mean, you move the needle at the front end, it's not necessarily as sensitive as it is on the back end when it comes to taxation and those sorts of things. So I would encourage people to consider some of those things like, okay, well, let's not get rid of all of the property. Yes, we don't necessarily want too many headaches and we might not necessarily want a negatively geared portfolio, but certainly consider the value of holding something and the increase in the value of that asset compared to when you sell it. You don't have a stake in the upside anymore. But really, it comes down to doing all of the modeling with someone that doesn't make their head spin. In fact, it energizes them and puts a spring in their step anytime they have an Excel spreadsheet in front of them, and we can smell our own.
Says my favourite tax nerd.
And I always come back to, I think, what Warren Buffett said about the fact that he has grown much more wealth, created much more wealth after turning 50 than before turning 50. And I think that's the sort of mindset that I would encourage everybody to have, because even just due to inflation, that's quite likely to happen. But, you need to have a mindset and expectation and plan to do that and achieve that.
Great story. I love it. Well, on that note, thank you. We've had a lot of fun with this listener question. And Kim, I hope this has given you some good food for thought, and everyone else who's tuned in. I'll see you guys next week.
See you.
See you later.